Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Beauty Farm Medical and Health Industry Inc. Annual Report. Beauty Farm Medical and Health Industry Inc. offers a wide range of services to cater to various beauty and health needs. At the core of their offerings are traditional beauty services, which aim to promote overall well-being through natural and holistic practices. In addition to traditional beauty services, the company also provides aesthetic medical treatments that focus on enhancing physical appearance through advanced medical procedures. These services are designed to address specific concerns such as skin rejuvenation, hair growth, and body contouring. The company's expertise extends beyond aesthetics, with a comprehensive sub-health assessment service that identifies underlying health issues and provides personalized interventions to prevent or manage chronic diseases. This proactive approach enables individuals to take control of their health and make informed lifestyle choices. Beauty Farm Medical and Health Industry Inc. also markets its own range of products under various brand names, including Beauty Farm, Palespa, Neology, and Cell Care. These products are designed to complement the company's services and provide customers with a holistic approach to beauty and wellness. Overall, Beauty Farm Medical and Health Industry Inc. has established itself as a leading provider of integrated beauty and health management services in China, offering a unique blend of traditional practices, advanced medical treatments, and innovative products to promote overall well-being. Beauty Farm Medical and Health Industry Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Beauty Farm Medical and Health Industry Inc. trades at a higher price-to-earnings ratio of 13 times and a higher price-to-book ratio of 4.09 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 77% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.49%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for various subsidiaries and investments of the company can be identified through an analysis of their financial performance. Revenue growth is driven by several factors, including high EBIT/revenue ratios, consistent annual growth rates, and changes in ownership and effective interest. For instance, Naturade has consistently demonstrated a 2.91-4.78% annual growth rate due to its high EBIT/revenue ratio of 13.3-14.72%. Similarly, Shanghai's revenue growth is driven by an EBT/revenue ratio of 4.07-5.15%, resulting in a 4.6-4.98% annual growth rate. On the other hand, revenue decline is often attributed to factors such as declining effective interest held and changes in ownership. For example, Guangzhou Naturade Huangzhou Traditional Chinese Medicine Clinic Co., Ltd., and Guangzhou Naturade Jiangnan West Traditional Chinese Medicine Clinic Co., Ltd., saw a decrease in effective interest from 90% to 70% in 2025, leading to a decline in revenue. Similarly, Shenzhen Naturade Best Medical Beauty Clinic Co., Ltd., and Shenzhen Naturade Hongli Clinic Co., Ltd., experienced a decrease in effective interest held from 90% to 70% in 2025. The company's investments in various cities also play a significant role in its overall revenue growth or decline. Subsidiaries such as Wuhan, Xi'an, and Guangzhou contribute to the company's revenue growth, while others like Palaispa and Chongqing experience declining revenue growth rates. Overall, the financial performance of these subsidiaries and investments is influenced by various factors, including EBIT/revenue ratios, annual growth rates, and changes in ownership and effective interest. Net income experienced a significant increase of 14.9% year-over-year, indicating a substantial growth in the company's financial performance. Furthermore, net income rose by 25.4% from Rm 800 million in 2024 to Rm 1,000 million in 2025, and an even more impressive 62.2% increase from 2024 to 2025. The improvement in profit margins was also notable, with a 1.2 percentage point increase to 41.9%. However, the overall gross profit margin saw a more substantial rise of 2.8 percentage points from 46.3% in 2024 to 49.1% in 2025. This suggests that the company's ability to maintain costs and generate revenue has improved significantly. The most significant improvement in profit margins was observed, with an increase of 6.1 percentage points to 64.3%. This indicates a substantial reduction in costs and a corresponding increase in profitability. The overall trend suggests that the company is becoming more efficient and effective in its operations, leading to increased net income and improved profit margins. The company's financial performance indicates a strong ability to generate positive operating cash flow. This can be seen in the consistent increase in net cash generated from operating activities over the years. For instance, in 2024, the company reported RMB 796,627 in net cash generated from operating activities, which increased by 25.4% to RMB 999,094 in 2025. Furthermore, multiple pages of the report confirm this trend, including page 12, where it is stated that the company has a net cash flow generated from operating activities of Rm 1 billion in 2025. The data also shows that the company's operating cash flow is not only increasing, but also becoming more stable. The year-on-year increase of 25.4% in net cash generated from operating activities suggests that the company is improving its ability to generate cash from its core operations. This is a positive sign for investors and stakeholders, as it indicates that the company has a strong financial foundation. In addition to the direct mentions of operating cash flow, other pages of the report also provide indirect evidence of the company's ability to generate positive operating cash flow. For example, page 259 states that the company has generated positive net assets acquired and contributed revenue, which is a key indicator of its financial health. Overall, the data suggests that the company is generating significant amounts of positive operating cash flow, which is essential for its long-term growth and sustainability. The company's debt level and interest expenses have undergone significant changes between 2024 and 2025. In terms of debt level, the total borrowings increased by a staggering 389% from RMB 149,774 million to RMB 732,129 million. This substantial increase is also reflected in the net debt, which decreased by only 18,518 RMB 0 compared to 2024. However, there are some discrepancies in the data, with one page indicating a decrease in total debt and another showing an increase of RMB 65,887,000. Despite these inconsistencies, it is clear that the company's debt level has increased significantly. The interest expenses have also seen a notable change, with an increase of 46.8 RMB 0 from 2024 to 2025. This rise in interest expenses suggests that the company is paying more for its borrowings, which may be due to the higher debt levels or changes in interest rates. Overall, the data indicates that the company's debt level and interest expenses have changed significantly between 2024 and 2025, with a substantial increase in debt and a corresponding rise in interest expenses. Management's outlook for the company is optimistic, driven by their belief in the power of digitalization to fuel future growth. They have introduced a proprietary model called AI Zion to enhance services and efficiency, and are prioritizing long-term value creation through strategic measures such as increasing dividend payouts and optimizing shareholder structure. The company is entering an era of precision cultivation, driven by branding, chain operations, and digitalization. This will redefine high-end beauty services and reshape the industry's value landscape through three key strategies. Management aims to promote high-quality development in the beauty sector through mergers and acquisitions, M&A integration and industry empowerment. The acquisition of Naturaid has expanded the company's direct store network, driving growth and earnings momentum. To achieve synergy across businesses, management emphasizes collaboration among headquarters, regions, and stores, empowering outstanding employees and successful teams to excel. In addition to business growth, management is also focused on sustainability, aiming to reduce environmental impact through energy-saving measures, simplified product packaging, and sustainable production methods in the supply chain. The company's low-risk investment strategy focuses on wealth management products, with estimated annualized return rates ranging from 1.2% to 3.15%. The company has a history of paying dividends and buying back shares. In terms of dividend payments, the company introduced a capital market value enhancement plan in March 2025 to increase its dividend payout ratio. The final dividend per share for 2025 was HK$0.72, representing a year-on-year increase of 38.5%. Although no dividends were paid by Shanghai Lianhuo to the group during the reporting period, a proposed final dividend of HK$0.72 per share is expected to be paid by the end of the third quarter in 2026. Regarding share buybacks, the company has not bought back any shares during the reporting period. However, it did purchase treasury shares worth RMB 24,888 in 2025, with payment for the repurchase of ordinary shares amounting to RMB 24,888 in the same year. Concerns about inventory buildup or supply chain disruption have been raised in recent reports. Specifically, aged prepayments outstanding for over 3 years, slow-moving products without expiration dates, and dull stock issues have been identified as potential issues, page 74. Additionally, inventory levels have increased from 1852 at the end of 2024 to 955 at the end of 2025, page 248, which may indicate a buildup. Inventory buildup is also mentioned as a concern on page 229. However, it's essential to note that these concerns do not necessarily imply significant problems. The company may be actively working to mitigate these issues, and further investigation would be needed to determine the extent of any potential disruptions. That concludes the financial summary for Beauty Farm Medical and Health Industry Inc. Feel free to comment below, and I will be happy to answer them when possible.